Hello, it is September 22nd, 2012, and this will be a market update. This update will focus on quantitative easing and the 2008 financial crisis that created a whipsaw in commodity market valuations and where you can expect commodity prices to go now that they have initiated a third round of quantitative easing. Now, before QE1, the Fed balance sheet was around $800 billion. In November of 2008, the Federal Reserve has started the purchase of $600 billion in mortgage-backed securities, which was the initiation of quantitative easing program number 1. By June 2010, the Fed's balance sheet was around $2.1 trillion, which marked the end of quantitative easing program number 1. After that, the Federal Reserve, around November of 2010, had initiated a second round of quantitative easing. This began a purchase of $600 billion in U.S. Treasury securities. By the end of quantitative easing program number 2, the Federal Reserve balance sheet had amassed around $3 trillion in debt. And this debt we do have to pay interest on. This is a very bullish case for gold. As you see, when they started quantitative easing program number 1, the valuations of spot gold had bottomed out around $700 an ounce and started its uptrend, which now has amassed a full $1,000 an ounce more at $1,775. It had topped out at $1,900 earlier before it started a triangle continuation pattern, which just recently, around June or July, it has broken out of its triangle continuation pattern and seemed to be on a way to retest its resistance lines. One is around 1800, where we are at right now. It's going to test that resistance, and if it breaks through that resistance, it will eventually have to test the 1900 resistance line, which has been in play since September of last year. If it breaks through the 1900 resistance line, you can expect a full bull run into a new continuation pattern comes around, which I would assume it should be another doubling in valuations. The last time we had a continuation pattern, a major continuation pattern in the spot valuations of gold, was during the financial crisis of 2008, which this was an upside down head and shoulders pattern which lasted till the fall of 2009. At that point, gold was slightly over $900 an ounce, and it went all the way to $1,900 an ounce before it started its next continuation pattern, which ended up to be a triangle continuation pattern, which I had mentioned from the start of the continuation pattern in my older videos from November of last year. So we can expect price valuations to easily go from $1,600 to $3,200 an ounce over the next year or two. Fundamental reasoning to back up the cause of this bullish case in gold can stem from the quantitative easing program the Federal Reserve has engaged in. Quantitative easing is simply the printing of money. The Federal Reserve create money out of thin air and buy securities that derive their value from hard goods. In this process, they create inflations, which will eventually create symptoms of inflation when this newly created money look for safe havens, because keeping this money in assets like US treasuries or other fiat currencies in the extreme over indebtedness situation that the global economy is intertwined within will leave people with the only option as to find hard inflation hedges for their wealth. So this of course backs up the bullish case for gold, which is why it has exited out of a triangle continuation pattern and seem to be headed on a new bull run, which we will test this bull run when valuations reach its resistance lines. Silver and oil is showing the same phenomena within their price valuations. The method used to gauge chart trends and chart patterns can be learned by using technical analysis. For those that do not know the subject and that would like to have an edge in buying commodities, stocks, currencies, indexes, or any other type of liquid valuated exchange market good, using technical analysis will give you a technical advantage when making your fundamental decisions in buying and selling.